The Intelligent Investor. Full extended summary. Introduction. What this book teaches. The Intelligent Investor teaches that investing success is not about genius. It is about emotional discipline, logical thinking, and a firm understanding of risk and reward. Benjamin Graham emphasizes that the investor's chief problem, even his worst enemy, is likely to be himself. Overconfidence, fear, greed, impatience. These emotions destroy wealth faster than markets ever could. The book teaches two paths: defensive investing, safe, low-effort, low-risk methods; enterprising investing, higher effort, careful stock picking, higher potential reward. Both paths can succeed if applied consistently and rationally. Chapter 1. Investment versus speculation. An investment operation is one which, upon thorough analysis, promises safety of principal A, satisfactory return. Anything else is speculation. Graham warns, speculation is not necessarily wrong, but it must be done knowingly, carefully, and limited in scope. The Intelligent Investor resists market fads, focuses on intrinsic value, not market price, understands that speculation should never be confused with investment. Chapter 2. The Investor and Inflation. Inflation is the gradual erosion of purchasing power. Investors must not ignore inflation. Simply holding cash or bonds is dangerous over long periods. Possible defenses against inflation include common stocks, though not perfect; real assets, real estate, commodities, but no asset class is completely safe. The key defense is diversification and realistic expectations. Chapter 3. A century of stock market history. Stock prices fluctuate. Markets have periods of extreme optimism and devastating pessimism. Over the very long term, stocks have offered attractive returns compared to bonds and cash. However, periods of overvaluation can lead to poor future returns. Bear markets are inevitable. Investors must maintain discipline regardless of short-term trends. Chapter 4. General Portfolio Policy. Defensive Investor. The defensive investor seeks freedom from the need for constant decision-making, maximum protection against serious mistakes, reasonable, not extraordinary returns. Recommended portfolio: 50% bonds, 50% stocks. Adjust slightly based on conditions but not wildly. Invest in large established companies. Avoid trendy stocks, aggressive sectors. Use low-cost index funds where possible. Key qualities needed: patience, restraint, skepticism of market enthusiasm. Chapter 5. The Defensive Investor and Common Stocks. Common stocks can protect against inflation better than bonds. However, the defensive investor should be cautious. Insist on buying stocks at reasonable valuations. Favor companies with strong financial health. Diversify widely across industries. Rebalance the portfolio periodically. Emotional detachment is crucial. Chapter 6. Portfolio Policy for the Enterprising Investor. The enterprising investor is willing to spend significant time and effort researching investments. Accept greater volatility, seek better than average returns. Strategies may include buying undervalued stocks, value investing, investing in special situations, mergers, spin-offs, buying bargain bonds, high-yield distressed debt, but risks must be controlled rigorously. Chapter 7. The Enterprising Investor and Market Fluctuations. Market fluctuations offer opportunities to the disciplined investor. The intelligent investor uses volatility to his advantage, buys when others are fearful, sells or holds when others are greedy. Never try to predict short-term market moves. Instead, respond rationally to market mispricings. The investor must remember that prices are there to serve him, not to instruct him. Chapter 8. The Concept of Mr. Market. Imagine owning a business with a partner named Mr. Market. Every day, Mr. Market offers to buy your share or sell you his share at a price. Mr. Market is emotional. Some days he is wildly optimistic, other days he is deeply pessimistic. The intelligent investor ignores Mr. Market's mood swings, acts only when prices are favorable, values the business based on fundamentals, not Mr. Market's opinion. Chapter 9. Investing in investment funds. Most individuals are better served by investing through low-cost index funds, well-managed mutual funds, rare. Cautions: high fees eat into returns. Most actively managed funds underperform the market. Past performance is a poor predictor of future success. Careful selection of funds is necessary. Simplicity often outperforms complexity. Chapter 10. The investor and his advisors. Financial advisors can be useful, but investors must be skeptical. Good advisors help maintain discipline, offer unemotional guidance, educate clients. Bad advisors chase trends, charge excessive fees, prioritize their own commissions over clients' interests. The intelligent investor uses advisors cautiously and remains ultimately responsible for his own decisions. Chapter 11. Security analysis for the lay investor. Security analysis means studying a company's financial statements, earnings history, balance sheet strength, competitive position. For defensive investors, I emphasize simplicity. Focus on large, stable, dividend-paying companies. For enterprising investors, seek undervalued, overlooked opportunities, require a margin of safety, avoid hype, rely on facts and sober judgment. Chapter 12. Things to consider about per share. Earnings per share, EPS, is important, but must be analyzed carefully. Watch for accounting tricks, one-time profits, changes in share count, dilution. Growth must be sustainable and backed by real business improvements, not creative accounting. The intelligent investor does not blindly trust earnings reports. Chapter 13. A comparison of 4 listed companies. Graham walks through real examples of how to analyze companies carefully. Study balance sheets, examine debt levels, look at consistency of earnings, avoid companies with excessive optimism or hidden weaknesses. Case studies show that careful, logical analysis beats blind faith in future growth. Chapter 14. Stock selection for the defensive investor. Checklist for defensive investing. Adequate size of the company. Strong financial condition. Consistent dividend payments over decades. Moderate price to earnings, PE ratios. Moderate price to book, PB ratios. Avoid speculation. Stick to proven, sturdy businesses. Diversify broadly to reduce risk. Chapter 15. Stock selection for the enterprising investor. For more active investors, focus on neglected stocks. Look for low PE ratios, low PB ratios. Seek companies with temporary problems, not permanent decline. Investigate thoroughly. Graham emphasizes patience. The enterprising investor must wait for the right opportunities, not chase excitement. Chapter 16. Convertible issues and warrants. Convertibles, bonds, or preferred stock that can convert to common stock offer potential upside, but carry hidden risks. Complex terms, potential dilution, poor liquidity. Warrants, options to buy stock, are speculative instruments and generally not appropriate for conservative investors. Chapter 17. 4 extremely instructive case studies. Graham shows how poor judgment, overconfidence, and speculation have led to major losses for investors, business collapses, overinflated valuations ending in disaster. Key lesson: beware of enthusiasm unchecked by rational analysis. Chapter 18. A comparison of 8 pairs of companies. In contrasting pairs of companies, Graham shows how flashy growth stories often underperform, how dull, steady companies can be superior investments, why skepticism is essential. The stock market frequently overvalues excitement and undervalues stability. Chapter 19. Shareholders and management's investors must consider management quality. Are managers acting in the shareholders' best interests? Are profits being reinvested wisely or wasted? Is executive compensation fair and performance-based? Corporate governance matters greatly. Poor management can destroy value even in good businesses. Chapter 20. Margin of safety. The central concept. The margin of safety is the foundation of intelligent investing. It means buying at a price far below intrinsic value, allowing room for error in analysis, staying conservative in assumptions. No matter how careful an investor is, mistakes are inevitable. The margin of safety protects against those mistakes. Final key idea: investing intelligently is about minimizing risk, not maximizing returns. Afterward, Jason Zweig's commentary. Jason Zweig updates Graham's lessons for the modern world. Index funds offer excellent solutions for most investors. Financial media increases noise and emotional reactions. Behavioral biases like overconfidence, loss aversion, and herd mentality are stronger today. Graham's principles remain timeless. Be skeptical, be rational, be patient. Stick to sound strategies and ignore market emotions. Final thoughts. The intelligent investor understands himself, stays disciplined through cycles of greed and fear, seeks margin of safety, always thinks in decades, not days. In investing, behavior matters more than brains. True investing success is not about making money fast. It's about growing it steadily, safely, and surely over a lifetime.